Do you have a chart on that?
What do you think? Do you think I have a chart on that? Do I have a chart? Do I have the chart? Send you 10 of them. Ladies and gentlemen, my old friend Larry McDonald, and by old it means we've known each other for quite some time. Not so much his age, although you got a couple of years.
I got some gray hair there.
little bit. All right, let's get right into it. No dilly-daddling. Let's get right into the bond market. That's why we're here. Bonds are getting smoked. Is this the worst start for the bond market ever?
It has to be probably since the 1970s. And the problem is that a year ago or so we had close to 75-80 trillion of dollars in bonds that were below 2% in yield. And then you also had about 20 trillion in the NASDAQ 100. And most people are starting to realize that some of the NASDAQ stocks are essentially long duration plays on a cash flow. So they're almost like bonds. So unfortunately, everybody was basically table max financial assets, bonds going into this.
The bond market is the biggest market of them all, right? $110 trillion market cap, probably less now, right?
Yeah.
With the volatility in the bond market, since it's the biggest and the biggest institutions in the world all have their fingers tied into this, it trickles down to the equities market. Stocks don't like a volatile bond market in either direction, no?
That's right. I mean, bonds are a great leading indicator. In 2018, you made some great calls in that third, fourth quarter. It was such a great time for markets because we had a big bull run in the beginning and then a dramatic, fourth quarter in 2018. And credit was leading equities the whole way. You were talking about it, and you were very vocal around high yield underperforming in that third quarter. And same thing with investment grade bonds. And credit often leads equities for sure.
Is it because the bond market is so big, or it's because bond traders are smarter?
I get that a lot. I mean, I ran a bond business at Lehman. So I started off on the equity side. So I'd spent my whole career in equities for half, and then the last half in bonds. And I would say that bond managers, because they manage an asset, that's priced at par and then matures at par, they have the risk reward for a bond investor. They have to be much more careful, right? So I think that's not that they're smarter, but they have to manage risk much more carefully because the convexity in bonds, if it goes like this Austrian bond this 100-year bond that they issued, I think it's down 60%. I mean, this is a bond. That's crazy. So yeah, bond investors have to manage risk more carefully. So it shows up, I think, more quickly. And bonds are more economically sensitive in some ways because you have a credit risk to the bond if there's a recession, whereas stocks can go down in recession and come out. The credit risk to bond investors is pretty high.
Let me ask you this. Is the bond market trying to catch up to what the commodities market has done, or is what the bond market doing pricing in what commodities are about to do?
You know what? It is amazing though. Commodities seem to have moved before bonds here, and you have done a great job, all-star team. And I noticed over the last 9 months ago, you were moving into some of these commodity hard asset plays. I remember Cameco, and you're way in front of this. And yeah, I think commodities have led here. I think because for the last decade, 20 years, it's been the 60-40 mentality where you had 60% stocks and 40% bonds, and commodities were really a joke. And so everybody's in the same trade because we had a decade of deflationary forces. I mean, just think of natural gas, right? I mean, natural gas had a 2 handle for much of the last 5 years, 2 to 4 range. And the U.S. was such a big producer of nat gas that nat gas itself, just by itself, was a massive deflationary force because it makes manufacturing that much cheaper in the United States, all around the world. And so, there's just been the last decade was Brexit's, trade wars, COVID's, natural gas overdose, and massive supply. And so you had all these 7 or 8 big technology, demographics, all these deflationary forces. Global supply chains were smooth as silk. And now all that's reversed. And so it's now a case where your 60-40 portfolio for the next decade is going to be more like 40% stocks, 30% bonds, and the rest in commodities.
Let's talk about that for a second, because you are much more global oriented in how you think and act, and so am I. But your typical American portfolios, like if you own the S&P 500, you've got 2% basic materials, 2% energy, and a ton of growth. More than half the portfolios in growth, large cap growth. Quarter of it is technology. If you own the NASDAQ 100, a lot of people do, shouldn't say most people, but a lot of people, consider the NASDAQ as to be the stock market. You have zero energy. You've got zero materials, zero financials. So that's just like a very specific segment. So just in the Dow Jones Industrial Average isn't much better, by the way. So, and I know, but just for the audience to be aware, to the point, Larry, where I talk to investors all the time, and they tell me that commodities are not even an asset class. It's just stocks and bonds. How quickly we forget the 2000s, huh?
Yeah, it's incredible. I mean, when I started in the business, the material sector was 11% of the S&P.
Wow.
In the 80s. And now, like you said, it's 2-3%. So we're heading back to the 80s, really. We're heading back to a period where materials are big. Now, you don't have to own commodities. You can we run a Bloomberg chat with about 650 institutional investors. It's live on Bloomberg. And I've noticed over the last year, a lot of them are treading in commodity equities. Your Glencores, your obviously
Freeport.
Yeah, Freeport. You've been bullish on the energy names. And now the biggest one, the last 2 weeks, seen a big shift into natural gas focused equities, Southwestern Energy, SWN. You and I have been focused on that. I love that chart. I think stocks double. I think you get a very much more limited. So these companies like Southwestern Energy, Energy Transfer, the last decade, because of that $2 natural gas threat, your credit risk to the equity was pretty high because these companies are levered. And what they use leverage for exploration, for all to run the company. So if natural gas's new floor is 450, and say your upside potentially to 9, if that's your new range, then the credit risk profile of these stocks is much better. So I've been seeing institutional investors really focus on these natural gas equities the last couple of weeks, and I think that's where some of the new hot money is moving into.
Let's talk market capitalization. In prior cycles, when these mega cap growth names and even smaller cap growth names, you're still talking about these like high flyers at $40-50 billion trading like penny stocks, right? So, and then you look at an Apple or Google or Facebook, you got $1 trillion mountain to move. But these energy stocks over the last decade, you look at something like Transocean, they used to be 150 billion, now it's 3, right? So when you talk about moving mountains versus flicking a pebble, right? I mean, you're looking at 2, 3, 4 baggers in some of these commodity centric. I mean, you've seen it over the last year already, 3, 4, 5 baggers. Some of these coal stocks up like 10 times, right? So the fact that they're so small but leaders in the space lets you own, like I said, leaders in the space, but you're still getting the juice.
Yeah, the service sector. The narrative from Wall Street over the last 2 years was that energy's lifespan for the sector is like 5 to 10 years. And therefore, the whole business model of the services, the deep water exploration companies, your OIH type names, those were considered capped upside. And now when you have this $100 oil and you've got 1 billion people in India without air conditioning, 1 billion human beings. You have 150 million people in India with no with no electricity at all. And then you have 1 billion people in China without an automobile. So people are waking up to the fact that, we've underinvested in energy for over a decade now. And there's about a $2 trillion CapEx hole in energy and metals, which has to be filled, but it takes a long time to fill it. So I think to your point, like Schlumberger, Rig, I mean, your upside now with those stocks is a lot better than the perception a year ago. And because now I think you've got them, and then the SPR, which is the Strategic Petroleum Reserve of the United States. If you look at a chart, I think you put one up, but they're taking it down to dangerous levels ahead of the midterm elections. And the United States is pushing a lot of oil out there that's out of our reserve. And we're going to have to fill that up in like a year from now. So that means your sustainability of oil from 80 to 120 is much better for the next 5 years now. So that's really bullish for your service companies. And so your Schlumbergers, your Rigs, and your OIH names.
I want to ask you about the curve. You're getting, everybody's a yield curve expert now, of course, Larry.
It's insane.
Hold on. But the funniest part is that you and I have been through many cycles already. You a couple more. But correct me if I'm wrong. Every time the yield curve inverts, like everybody's like, oh my God, the yield curve inverted. Like you remember prior cycles, the same thing. But for me, the hilarious part, it's like, yeah, it inverted today, but it's been flattening for a year. So like you saw it coming, like, the line's been going straight down. You figured eventually it'd get to zero. It just happened to be a Tuesday and not on Wednesday, Yeah, it was today, but like, it's not like we woke up in the morning and be like, oh, yield curve inverted, right?
Yeah.
Talk to me. What does it mean to you?
Well, I think like you, I use a basket of these things. So the yield curve by itself is like the best indicator that we have as a risk indicator to go along with when the yield curves also invert, and this is also happening, is really telling. And that's the staples versus discretionary. So your XLP, yep. And what we do is we measure how much your staples versus your XLY, which is discretionary stocks, so discretionary spending. So if the staples are outperforming discretionary names by, say, more than 8% in a quarter, so the acceleration of that outperformance, that means that billions of dollars is flowing out of discretionary names and into recession-proof type, like Campbell Soups and your Costco's, your Walmarts. And so that, to me, is if that's happening at the same time as the curve's inverting, then the probability of recession is much higher. So I think
throw high yield versus treasuries in a similar category?
Yeah, exactly. So in this case, high yield is still, it's giving you warning for sure. But the spread is nowhere near 2018 levels, right? Oh. Like you and I were looking at, I remember you and I were we think we did one of these in the third quarter.
We've been doing this a while, Larry.
Yeah, we've been doing it a while. But the staples versus the discretionary names, so we have a chart which shows staples versus discretionary versus the S&P. And what's fascinating about this chart, we go back 30 years, when the white line, which basically measures how much the staples are outperforming these, so the XLP outperforming the XLY, and then you can see on the white line the acceleration of this. When that's moving fast, which it is now, then it's a very telling warning sign. And that's happening now, so your staples are crushing. Like, what's wrong with this market now? I mean, you've got the two leading groups of the last month are staples and utilities. So, it's like that and the curve's inverted. You know what I mean?
Hold on. And utilities outperforming with rising yields.
Yes, that's weird. And,
right?
And I think what it's happening, JC, what happens as the storm approaches, right? People still have to be invested, really, because your pension. There's slow money and there's fast money, right? So your fast money are your hedge funds, and they move in and out. But your slow money really, it has to stay invested. It hasn't been scared out of the market yet, right? So what happens is there's a flight to quality. That's why Apple's outperforming the market, right? That's why you look at GM down 30%, Home Depot down 30%. I mean, there's just so many consumer-facing names that are down 30%. And Apple's like 5% off of the highs. It's the same thing with the utilities and the staples. So money sees something the money capital sees a risk in the future, and it's moving into the higher quality, flight to quality stuff, and then what I call the crown jewels, and then the last stage of when the crown jewels give way.
I don't know anything about your crown jewels, but which yield curve do you give more weighting to, the 2s 10s or the 3-month 10s?
The 3-month 10s, people that I really respect over the years have really, and they've been pounding away on this. The 3-month 10s are nowhere near inverted.
Right.
And I have to say that the RRP facility, this repo facility that the government has put forth, the Fed, has really changed the front end of the curve. We did a call with Scott Scurum, Scott faces institutional clients on the repo side. And this, it's a $1.5 trillion, $1.7 trillion facility that didn't exist 5 years ago. And the Fed is using it to try to manage risk in the market and keep liquidity pumping. So that is distorting the 3-month and is keeping it up because there's still plenty of liquidity that the RRP is churning out every day. So I think it's distorted a little bit. And I think so 2s, 10s, 5s, 30s, I'm looking more at those. And but we're also looking at a basket of things together.
With rates rising, utilities have been some of the best performing stocks in the United States. And regional banks have gotten hit with rates rising. Who's got it right, the bond market or the stock market, Larry?
I tell you, these regional banks are like, especially the ones that are focused on, that have exposure to the big cities, like New York, like Signature, New York Community Bank. So there's definitely all this forbearance stuff on commercial real estate is coming back to bite some of these banks. And it's one of these things that's been swept under the rug. It's a piece of credit it's a credit risk that, think about it. You just have like 30% of the tenants in New York have gone, right? And now you have all these old real estate. Look how much real estate deals were done over the last decade in Hudson Yards. Hudson Yards. That thing was just built in the last last 7 years, right? And that's a huge amount of commercial real estate that came into New York. So, yeah, I think that there's a credit problem with commercial real estate. And we ran a chart. We did this video on our website, and it showed the CMBS ETF, for example, versus the S&P, and it's like your S&P charts like this, and your CMBS charts like that. And so the banks are exposed for sure, and that's another one of these leading indicators that's starting to make some noise.
Sounds like you're all bared up there, Larry.
Well, not really. I think there's sectors that are.
You were texting me about Fade and Tesla and Apple the other day.
I hate Tesla here. I hate Apple here. I think that it's just everybody's floating into the safety stocks. But the banks are going to be a buy here. They're not quite there yet, but like Citigroup off 40%, Goldman Sachs off 20s, I think 27, 28. If you buy the banks when over the last 30 years, when the staples are outperforming discretionary stocks by this amount, and you buy into the banks in that part of the cycle, and you got to be careful on the way in. It's been a great trade, and so we're looking at natural gas companies, like I said, uranium, hard assets, silver miners. So we have a model that measures the silver miners versus, say, gold miners. And the outperformance of silver miners versus gold, what's happening is Elon Musk and a lot of these electric vehicle makers are starting to contract out commodity deals in magnesium and a whole different portfolio of metals. And so we're having this green revolution. Everybody's focused on electric vehicles, but they're not focused on the metals necessary to grow the cycle out. And so I think with silver and copper, you've got this demand underneath the surface that's never been there before. And you also have a macro side, right? You've got whenever the Fed, now let's talk about the curve again, right? So the terminal rate is the point where the Fed stops, right? So the last cycle they stopped at 2.5, and the cycle before it closer to 5. So it's where the Fed stops. So if they hike 25 basis points all the way up to 2.5%, and that's the terminal rate where they stopped last time in 2018 when Powell embarrassed himself in front of the world by going, fully promising, and remember, Goldman Sachs told us in 2018 that they were going to hike rates 4 times in 2019, and they ended up cutting twice. So this period today is just like that, where the terminal rate, the streets, like the sell side is telling us that the terminal rate is going to be 3 to 3.5%, or anywhere between 2 to 3. There's a couple of analysts that are saying that means the Fed's going to hike all the way up to 3%. I don't see it. I think the terminal rate is more like 1 to 1.5, where if they hike 50 basis points twice, I think they for sure put us in recession. And the bottom line is metals do really well when you come to the end of a hiking cycle. So if you have a shorter hiking cycle, metals crush it. A long, boring, hiking cycle like 2004 to 2007, whatever it was.
Yep.
We did like 17 rate hikes over 4 years. And you need a short hiking cycle for metals. And if that's the case, then I think the metals are double from here, the double, triple.
Base metals, what about precious?
Well, precious metal miners. So I think your downside is...
So both base and precious?
Oh, well, no, good point. The base do great early in as you're coming out of the recession, like we did in COVID. Base crush. So tech resources, you've been great on that one. You nailed that one.
Great chart. I mean,
that was a great, and you pointed out like a year and a half ago, and that's one of our core holdings. And so your tech resources have led in the early stage, the first year and a half of coming out of the recession. Then the precious metals, as you get closer to the recession, that's where the precious metals start really taking off. And so, yeah, I think that like the SIL ETF, your GDXJ, your GDXs, those, I think you've got potentially 200% upside and maybe.
Hold on, don't you need lower real yields to get those precious metals going? You think we get that?
Yeah. Now remember, the Fed can only hike rates so much before causing a recession, right? And so the 2-year is up. Last cycle the 2-year got up to like almost 3%, 2.9% on the 2-year in 2018. And so now we're like 2.3, 2.4. So we're getting up there in twos. And the ability of the Fed, remember, to answer your question, you're correct. But I just don't remember, there's 30 trillion of debt, JC. This is not unfunded liabilities. Really, there's close to 270 trillion of unfunded liabilities, but just liabilities that the United States has today in just national debt is 30 trillion, right? So 1% move up in yields is an extra 300 billion of interest. And so the Fed just can't push rates up that much. And so I think, and then at the other side of the coin is when inflation expectations are moving faster than bond yields. That's another thing that would help precious metals. So you're right. If the Fed were to just push up yields consistently for like the next year and a half, it'll be 2 years, gold and silver would get hammered.
But as long as inflation is beating rates higher, then precious metals will be fine in that environment.
That's one. And the other home run is when the Fed, makes a move and then pauses. Like 2016.
When they screw up.
Yeah. In the first, look at gold and silver miners in the first and second quarter of 2016. They're up 150% in 6 months. And it's because the Fed,
everything ripped.
Yeah, the Fed was I was in meetings at SocGen, and these economists were sitting with clients, and they're pounding the table that in an election year, we're going to hike rates 4 times, 2016. And I said, what planet are you guys on? I mean, just seriously. And sure enough, the Fed promised all these rate hikes, and then they walk it back. And so we're in a very similar period now where I think the Fed uses the sell side like pawns, right? So they want to there's 2 stages to monetary policy. There's the jawboning, and you could actually, you can actually tighten financial conditions and with just jawboning, right? That's what's happening now. So they leak stuff to Goldman Sachs. They leak stuff, and they basically say they want the economists to go out there with all these, 20 rate hikes in the next 2 years, whatever it is. And it's a bunch of bull. It's really the Fed using a bank as like a pawn to move, expectations. And so the banks do all of this, jawboning up and then have to walk it all back. And as an investor, you got to be very aware of that because it's a lot of BS.
I love you for that, Larry. I love you for that. I wanted to talk about the dispersion that we're seeing at the sector level and at the individual country level. So you've got some of the highest return dispersion among sectors in 20 years since Q4 of 2000. Was the most we saw. It was energy up like 37% and communications down like 11 or 12% or something like that. It's almost 50% of dispersion, like crazy, right? And then at the country level, you got your Latin America, ripping. Some of these other emerging markets, top 10 performing markets around the world in Q1 were all emerging markets. And then you got European stocks getting slaughtered, Italy and Finland and all these things. And the United States not doing very good either for that matter. Talk to me about the dispersion. Is that something that means anything on a more macro level? Or does that just reiterate all that other stuff like, yeah, base metals and energy are doing great. Of course, Latin America's outperforming, right? So like, talk to me about your thoughts on some of the highest dispersion you've seen in your entire career.
Absolutely. Commodity producing countries. You've been bullish on Brazil. Brazil's done great because 60% of the GDP, 70% is commodity based.
Yeah, but they didn't do well in 2021. That's a new thing this year, by the way, Larry.
True. And they got nailed with COVID. It was so bad. It was like the media is your best friend. They were doing like when Brazilian stocks were on the lows, the media is like global epicenter, and they pictures of Sao Paulo and they hate Bolsonaro. I mean, Bolsonaro is not a nice guy, right? But the
Never
media
met the guy. I don't even know who the hell you're talking about.
Yeah, well, exactly. We're not going to talk about geopolitics.
Is he a big deal?
But they really go out of their way. No? What's that?
Did that guy play for the Yankees?
Oh yeah, yeah. He's a shortstop. But they go. My point is, the media goes out of its way to really kind of trash some of these trades, and that's often a good indicator. But for Europe, the problem is negative yielding bonds in Europe in August. During when we had the Delta variant, August, September, and that really scared a lot of investors. Negative yielding, the amount of negative yielding bonds on the planet Earth, and a lot of those were in Europe, was 17 trillion in August, September. And now, breaking news, as of like today, tomorrow, well, sometime in the next couple of days, we're going to go back to zero for the first time in almost a decade. So yields in Europe are screaming higher. You've got elections over there in France. You've got big fiscal plans. I mean, think of like Germany. This country, Germany, was like black zero, austerity. Black zero is their kind of like mantra for like the ultras. I mean, they were like literally torturing the Greeks around austerity in 2011, 12. I'm torturing other countries around austerity. And now they're going, there's a bailout for energy. There's a bailout for COVID. I mean, this is the Germans now. I mean, this is absolutely crazy. So, and everybody's got a bailout for. So you went through a whole bunch of bailouts for businesses and individuals, for COVID, and now it's the energy bailouts. And so the deficit spending is off the charts. The amount of bonds that have to be sold is off the charts relative to the previous decade, and that's what's causing this kind of like, as you wisely point out, this dispersion is just like never seen anything like it. And I think it's because of that kind of like the tale of two worlds, where you've got commodity producing countries on one hand, and then you have countries in Europe that have lots of debt with interest rates ripping.
My suspicion is that you believe the dispersion continues and you stick with the secular leaders. Just shut up and buy Canada, Australia, South Africa, Latin America, Peru, Chile, Brazil, Mexico. Like, stick with that?
I think you stick with it for the balance of the year, because this move in like, we did a tweet today. These French, if you look at just like the French 10-year, right? The French 10-year, we made a chart, and I'm not a chart. I want to say you guys are pros at charts, right? And you're real technicians. We use charts from a macro perspective, but just a simple chart on France going back, 40 years, you're talking about the 10-year breaking, big levels. And so you're going to have higher yields in Europe. And, what stocks do well if yields are ripping in Europe? There's certain sectors, commodity-based companies probably, but there's a lot of sectors that don't do great and you're breaking multi-year trend lines.
So, Larry, when interest rates are going up, the more value cyclical-oriented stocks and sectors tend to do well, and the growthy long-duration names, like you mentioned, technology and stuff like that, tend to do poorly. And as it turns out, those value-oriented, more cyclical areas have been doing well, and the growthy areas have been doing poorly, and interest rates are going up. So what's everybody all making a fuss about? Seems pretty normal.
Yeah, these DCF models, they've blown up so many. These Tiger guys were just like table max long.
DCF model, is that anything like a DTF?
Discounted cash flow, but it's like, think of like a company like Netflix or a software company. Think of the CLOU ETF or Microsoft, companies that produce cash over longer periods of time. And essentially, it's almost like a bond. So with some of these companies, they were trading at 20, 30, 50 times sales, 70 times sales, because they have their long duration instruments that pay out cash flow over long periods of time. And the DCF model with interest rates at zero and deflation, those businesses have much higher valuation, right? So if you have deflation and interest rates to zero, you can make the case that these companies should trade at 50 times. Whereas if you have inflation at 9% and rates rising, those DCF model stocks just get blown up. And that's what's been happening within the NASDAQ. It's still, like, you've got 30% of the NASDAQ, it's down 30, 40, 50%, maybe 40%. And so you've got real carnage in the NASDAQ, but other parts of the NASDAQ really haven't been hurt much at all.
Do you group Bitcoin and cryptocurrencies into that long duration growth category?
Well, Bitcoin's in a stage now where it's still in the speculative realm, where if financial conditions are tightening, it's not doing well. Over time, that's going to change.
You think that because the correlations between the NASDAQ and Bitcoin's off the charts these days?
It's incredible. Or the VIX. I laugh. I give these guys a hard time, but they are. If you're long Bitcoin, you're really short the VIX. You're short the VIX. So if the volatility index spikes, you're going to get hurt. And so, but crypto, when the VIX is elevated, one of the best ways to short volatility, instead of like going in the futures market and shorting the VIX, you can just get long crypto. And it's been a phenomenal trade. So whenever you see that VIX, with a high 28 handle, it's a great time to buy crypto. Absolutely.
Are you orange pilled? Are you into the Bitcoin?
There have been a couple of stages where when the ratio got up to 38 to 1 versus gold, to me, that's a sell signal. And maybe 3 or 4 weeks ago, Bitcoin reached 17, I think it was 18 to 1. So I think 17, 18 in that 20 to 1 realm, gold to Bitcoin, or Bitcoin to gold, excuse me. When that ratio gets, I'm going to be, Bitcoin's here to stay. I want to buy it right. And I think there's too much volatility in it. You know what an amazing stat?
The Bitcoin to gold, because Bitcoin is so much higher beta than gold, the Bitcoin to gold ratio looks like a Bitcoin. If Bitcoin's your numerator, it's going to control the fraction, Larry.
True, but whenever the ratio has gotten into that 15, 16, 17, 18 range, that ratio, Bitcoin's been a great buy. And when Bitcoin's got up near 40, it's been a sell. So there's something about it. Like, people are like, I think real money accounts, they own both. I think that the trick is to own both and reweight it based on how expensive they are versus each other.
So you think gold and Bitcoin go to 1 to 1?
God, no.
Well, Bitcoin, in terms of market cap, I should say. Sorry.
in our lifetime, not in my. I don't see it in our lifetime. I'm sure that
12 trillion. So that would be what $500,000 Bitcoin gets us there with gold staying even.
Yeah, I mean, I don't. By that time, the federal.
Are you being a boomer? Or are you being open-minded?
I just think the Federal Reserve will step in at some point and won't let it get that big. They don't like big competition, right? And you have that much capital outside their control. I just don't see it. But you're right. I'm a boomer. I'm not really a boomer, and I'm under that boomer age, but I'm pretty close.
I know, but are you thinking? It's how the kids talk these days. Like, are you being a boomer, or are you like open? Are you orange pilled? Like, remember, you can't be in the middle. It's got to be one or the other.
The problem with these kids, my hairdresser is telling me to buy Bitcoin. Right? I mean, she's table max long, and she's a sweetheart, but she's not really a great investor. And I just say, like, you want to buy this stuff when, not stuff, but you want to buy Bitcoin when. Remember, I was going to say this. If you look at this, we have a chart. The last 12 years, 68% of the time, the last 12 years, Bitcoin has been in a 50 to 80% drawdown. Think about that. So you're going to have lots of times, lots of chances to buy this asset a lot cheaper than it is.
Larry, let me ask you this. When I look at these cycles, and you bring up a great point as to how many times Bitcoin has been destroyed, it reminds me a lot of the 1800s in the stock market, when you had like the panic of 1980, the panic of 1982, the collapse of 1984 or 1884. Like, there was like another crisis or panic like every other year. Reminds me a lot of how fast the cycles in crypto markets have been going. Is there a certain element of like newness, like, how immature that our stock market was in the 1800s, where the cycles were so fast, and sort of a new market now and the cycles so fast? Is there an element of that, or no?
100%. This is like a Gatsby era. I mean, there are the movie The Gatsby with Leonardo DiCaprio I thought he was fantastic, but it really shows you that amazing period in American history where you had, the nouveau riche families versus the old money families, and the resentment of the two classes, and you had incredible wealth that was created in a very short period of time. And same thing now. It's you've got crypto, and it's generational. You've got your blue hair, your boomers with the gray hair, and you've got this nouveau riche. And you know what's fascinating about this? When you talk to people on Capitol Hill, one fascinating thing about crypto, to its credit, is their influence. And I spend a lot of time on the Hill with ACG Analytics. We've been partners with them for over 15 years. And if you talk with the senators, the congressmen on a regular basis, the influence over the lobby for crypto has gone from 10 miles an hour to 90. In other words, the amount of senators that are bought into the crypto industry and the influence of the crypto industry over legislation has gone up like 500%, which means that it's a massive secular change and here to stay. And guys like you are going to be more and more valuable because you need to trade this stuff the right way, and it's not going away.
All right, so you're not bearish. How bullish are you? What's the ceiling on Bitcoin in the next 2 or 3 years? How high do you think it could go?
Well, I think that we're probably in the middle of a big drawdown. We probably go down. I think I'm bearish like short term next year, but then, we probably go to new highs in Bitcoin in the next year and a half.
You're bearish Bitcoin because of its long duration, and you just don't like that group, right? Is that part of it?
That's part of it, but it's really financial conditions. So if the Fed's tightening financial conditions, so if you look at the financial condition index versus Bitcoin, it's crazy. I mean, once again, so when you're long Bitcoin, you're short the VIX essentially. But when you're long Bitcoin, you're essentially you're going up against financial conditions. So as financial conditions tighten, if the Fed's trying to tighten, they're promising Bitcoin does not do well anytime in its lifetime when financial conditions are tightening. It's just not a big enough, like you said, it's not mature enough. The pool's not big enough. If one billionaire is going through a divorce and he has to liquidate, a couple $100 million of Bitcoin, he's going to really move it. And whereas if financial conditions are loose and there's lots of money around, it doesn't, like, big players coming in and out of Bitcoin don't move it around as much. But when financial conditions are tightening and people need liquidity, and you just have more and more players coming in and out with size blocks, and that just knocks it down dramatically. And that's where you guys, like, all-star charts, you want to be there at the right time for those moments.
So I cut you off when you said how high you think it could go in the next few years. I
guess within the next 3 years, 150,000.
That's what that was my bet that you were going to say, about $150, 200. Yeah, I could see that. And then, are there any other coins that have your attention? You think do you believe in the flippening between Ethereum and Bitcoin, or you not go down that rabbit hole at all?
Well, I'm not sophisticated enough. All I know is, in our chat, we have a number of very talented investors, a number of billionaires in there, and it's a live chat, and it's on Bloomberg. 23 countries, clients all around the world, family offices, hedge funds, mutual funds, pension funds. And the language in there around Ethereum and in that platform and how it can be used relative to Bitcoin in terms of applications and things like that, it sounds like the upside in Ethereum is much greater than Bitcoin. But I'll leave that up to the specialists, because it's an industry you really need to do your homework on, right?
Ladies and gentlemen, Larry McDonald, I recommend everybody go buy the book, Colossal Failure of Common Sense, which is just a great story. I mean, it's a great story if you're reading it now. If you went through it, it probably wasn't so great. But, Larry tells the story of the collapse of Lehman Brothers, being told by a bond trader at Lehman Brothers, and that just so happens to be my old buddy Larry. Right? Well,
I'm really proud. The book's now in the top 20 all-time at the CFA Institute, and it's one of the best-selling business books in the world. It's been translated into 12 languages, and I tell my wife once a month, as a former Lehman trader, I say, honey, if we sell 1 million books, we'll break even on our Lehman stock. So get out there and buy one.
Where else can they reach you, Larry? Where can the folks find you?
At ConvertBond on Twitter, the Bear Traps Report, and on Bloomberg.
Love it. Larry, always one of my favorite conversations. We talked a lot of global macro. We didn't even get into the dollar. We'll save that for part 2.
Okay. See you, brother.
All right, later.
Okay,
adios.